Hello, everyone, and welcome to part two of our case study on investing in an Officetel in Korea. My name is Dan Rue. I am a real estate consultant focusing on mobile home parks, and I work with private equity groups. And on the line with me is Symon He. He is a former private equity analyst and also rockstar Udemy instructor. Simon, welcome to the conversation.
Hey Dan, thanks for having me again.
How have you been this weekend?
Good.
Are
Just
you enjoying these talks that we have?
Yeah, absolutely. I think it's something that a lot of students are curious about. A lot of my students are curious about because they're coming from all over the world, but a lot of them aren't just looking at investing in their own markets. They're interested in looking at foreign markets.
Exactly. I know there was a really awesome post recently about the Asian market. I actually copied that post and put that into the one of the Facebook groups that I had. But was that Chris? I believe I
Yeah, it
forget
was
who.
Chris. Yep, Chris
Yeah, that yeah
Aiello.
that,
Yeah,
yeah.
he's an investor out of Hong Kong, and he looks at I think Japan, Hong Kong, and kind of more of the Southeast Asian markets there.
Mhm.
Really knows a lot about that market. So
Yeah, I mean, it's interesting with technology and stuff. I began my investing career actually while I was living in Korea and investing in Jacksonville, Florida, a state I'd never visited before. Purchasing a single family home there that I had never stepped foot in. And with technology and the way things are and the ability to network and groups like the Seoul Real Estate Investing Meetup, we have people on both sides of the ocean just being able to, like with Chris moving to Hong Kong, or I don't know if he's originally from there, but investing there. And then we have people in Korea who are interested in investing in America. It's like it's become very global in terms of real estate's
yep,
investment opportunities. Yeah.
yeah. All
All
right.
right. Well, let's without further ado, I think if this is part two of the case study, so we kind of reviewed part one, and there's a YouTube video on that as well, which I will include a link to that in case people missed part one. But we're just going to go into. Why don't we skip ahead to the questions that we had?
Sure. Let me
Yeah. All right.
question.
There we go. Yeah. All right, let's do this real quick. So,
Okay.
information about the property. So, basically, someone in the Seoul Real Estate Investing Meetup group had asked a question about how would you analyze a property in Korea. So, we decided to do an analysis on an Officetel, which is like a one-room studio apartment in Korea. These are some of the metrics. There's a PDF that will be attached to this video, so you could take a look at all these numbers. But you can see the property price here, the expected monthly rent. This is an income producing property, so we'll be looking at the analysis from that perspective. And then let's move forward. Some more information about the price. Again, this is all covered in part one, so we're just going to skip through it real quickly.
Yep.
And okay, and so based on the information given, some of the questions that we wanted to answer on a financial analysis was what type of returns would this property generate? Would you invest in this property? Why or why not? If your answer is yes, why? If your answer is no, why? To make things more interesting, if your answer is no, what would you have to change to make this deal investable for you? And what would happen if we put financing on the deal as well? So I know, Simon, you went ahead and you took all this information, and I think you prepared some good stuff for us here, right?
Yeah. Here, let me pull that up.
All
So,
right.
all right. So this is actually an investment model that I built that is designed to handle kind of a single unit rental property. So it could be a single family home, or in this case, it can be looking at a Korean office tel. But anything where you're buying something, you may or may not be making some renovations, and then trying to lease it or rent it out to the market, then this will give you an opportunity to evaluate that investment opportunity pretty easily.
Mm-hmm.
So for people that are not familiar with looking at investment models, and basically what it does is you taking the assumptions that you have about your investment opportunity, and you run through a cash flow analysis, and then it automatically calculates the most important metrics for looking at an investment. So we're looking at things like the IRR, the internal rate of return for an investment, as well as cash multiple. Just very quickly, they measure different things. We can kind of go into more detail later around that, but right now I just want to kind of show a quick demonstration of how an analysis can be very easily done.
Very good. So this, just to take it a step back, this is now I make spreadsheets too sometimes, but this is a spreadsheet that you actually created, right?
Yeah.
Okay.
I built it from scratch, and it can do quite a bit. So
I was just looking at those tabs at the bottom. Sometimes my spreadsheets might go 1 or 2 tabs deep, but I'm seeing a lot more tabs here on this one.
Yeah, we can go into a little bit more. And the yellow tabs are the tabs where you actually input assumptions. And all the other gray tabs here are either summary tabs that kind of provide a nice, printable summary, so you can share that with, or it provides graphs to show what it looks like, right? So this one right now is showing kind of what the cash flows are looking like. And there's something that's a little bit deeper here that is, for a lot of people don't invest by themselves. They have investment partners.
Okay.
This has a whole built-in waterfall framework. Basically, it's a framework that is used by professional investors, used by institutional investors to evaluate their investment structures or relations with other investors and see how that changes. So it has that built in. You can look at that as well. It has a full annual P&L for that, and then it has the kind of the engine where all those formulas and calculations are going. Including an amortization calculator, which we may or may not use. Probably will use to test out some ideas here.
So the good thing is that, there's a lot of numbers. It can be a little bit overwhelming. But for the investor, really what they focus on are the yellow tabs, the input tabs, right?
Yep.
And then that's it. And then if they see yellow, put in a number. If they don't see yellow, you don't need to put in a number. And then it seems like the spreadsheet kind of spits out all the information that you really need.
Yeah.
Okay.
It's just basically you need to learn what's in it, how to use it, and then once you know how to use it, you learn how to interpret the results, and then that can help you make a more informed decision about what you're looking at.
Right. So now you get all the financial data, the information that you know, and things that you're guessing at. You put it in, and it'll tell you a little bit more about your returns. Now I notice it's all in dollars, but that's something that could easily be converted if we wanted to.
Yeah. And this one right now, it just designed to show it with the dollar sign, but it's really meant to just mean currency, right? You can change it to represent any currency. And then what I've done to make a note here is that all the numbers here are going to be in the Korean won in thousands.
Okay. Right.
Any numbers I put in now, I'm going to put it in thousands and Korean won. That's what I'm using.
Imagine 3 more zeros if you're doing Korean won. Okay, perfect. All right, why don't you go ahead and walk us through it then?
Cool. So the assumptions, if you're thinking about a rental income property, there's going to be some core set of assumptions that will apply for an investor that they need to think about, right? At the very basic level, you need to think about how much rent you're going to be collecting. And in our case, we're going to be collecting 900,000 won a month.
Which is about $900 for people who aren't familiar with Korean won. Yeah.
Okay, it's about 1,000 to 1.
Yeah, it's about 1 to 1. It's like what, 1,200 or something. But for the purposes of this, just think of it as dollars.
Okay. Pretty close.
Yeah.
And then the purchase price is 250 million Korean wons, right? And this one is just for kind of the purposes of the graphs. For the calculations, you want to see when the dates are happening. If you dig into the specific calculations, so you put a date there, but it won't change the investment calculations.
Right.
Whether you're adding any kind of closing costs to this, usually in the States you're looking at somewhere between 1% to 2% closing costs. I don't know if we talked about what the closing costs are for this particular deal. I left it blank for now, but we can add it.
Yep.
So if we want to put in 1%, we can just
just add it in there.
Yeah, we could just add like a 250, 2,500 for 1%.
Right. Right.
So then you can see that the calculations actually adjust right away.
Right. Right.
Yeah. And then renovations. So this one is looking at, for a rental property, you're buying it, and you may have to do something to it. Maybe even as little as putting paint on it and doing some minor touch up, or you may do something more significant, right? And usually the renovations happen before you lease it up the first time and right before you sell it. Maybe you've held it for 5 or 7 years or 10 years, and then before you sell it, you might put a little money into it again, you know. And so here the assumption is, well, are you making any renovations in the beginning? We're putting a little bit, and maybe it takes a month, right? So if it takes a month, we're going to delay it by a month, and that's what this renovation period is. If it takes much longer, then then basically you're renovating for a longer period of time. While you're renovating, you're not able to collect rent, and that's why we got to properly account for that. Then the other big assumptions then is going to be around, are you going to get financing?
Simon, just real quickly on the renovation period, the 1 month. So what it would do is it would take line 12 and it would say, we're starting on January 1st, and it wouldn't let the income start coming in until February, basically, in the first year's calculations.
Yeah.
Okay, perfect. Yeah, that makes sense. Yeah, because you're gonna need 1 month to fix it up, right?
Fix it up, exactly.
Perfect.
And you can make it longer if you think, hey, I'm going to take longer to renovate, but I'll still need another 3 months to find a tenant. Then you can make it longer. Yeah.
Like 3 months or 4 months.
Exactly.
Yeah, exactly.
Yeah.
Perfect.
Yeah. And the other one is financing, whether you're going to take on debt or not. Right now, we're going to assume that we're going to do it all cash first. We'll change this later. So I would just put 100% equity. Equity means, what is it coming directly from the investor versus, the taking on debt. So there's no loan amount here because we're putting 100% cash in, right? So that means in this case with the zero loan, these metrics don't really matter, but it will matter if you do take on debt. We're making for rental income properties, it's almost always, and it'd be silly for you to take on short-term high interest loans, unless you're taking that just for some sort of renovations that you're going to then amortize later, kind of refinance out. But usually you're looking at longer term, fully amortized debt for these kinds of investments. So the model is designed to do that. And you put in the how long, the loan term is, and then what your interest rate is on that. And then all of it will be calculated.
Right. And just real quickly, amortization is the number of periods it gets divided by that many years to pay back the entire loan plus the interest on the debt.
Yeah.
Okay, great. Just in case anyone's
it's just like a mortgage.
Sort of learning the terminology. Yeah, amortization, mortgage, same thing. Yep. Okay, so this means that you're borrowing that you would be if you did have a loan on this, it would be over a 25-year period that you'd have to pay back the loan at 5%.
Yeah.
Yep. Okay.
And then exit assumptions. So this model can hold it up to 7 years. And then so we can make an assumption for how many years you want to hold this investment before selling it. And then when you sell it, well, you're holding it for some period of time, you may have some appreciation, right?
Sure.
So you can make some assumption around what that is. I don't know if the person who made the request gave us an idea what that was. So I left in just a placeholder of 5% right now.
5%. So is that 5% compounded annually, or is that just 5%? So at the end of 2 years,
it's per year, percentage
per year. Okay.
Yeah.
So it'd be 25. Yeah.
So also these assumptions here, they're labeled for that's a great question, right? When is it overall or is it annually? So this is an annual compounded rate. Yeah.
Right. Okay.
So 5% over 5 years, the 250 now becomes 319.
Okay.
Right. And then usually there's some sort of cost of sale. You're going to have to pay a broker fees or some closing costs. For most residential markets, you're looking at somewhere between 4 to 7%, no matter where you're at. But we'll just put 6% here as a placeholder to be safe.
Right.
And of course, there are some other things that impact your investment in a rental, right? You're going to have some vacancy probably. You're holding it for 5 years. You can't assume you're going to have that one tenant being there the whole time and you wouldn't have any vacancy at all. You might have some turnaround. So you can make some assumptions around that as well here. And it's hard to think about a vacancy rate in terms of a percentage. So I put the equivalent weeks empty per year here, so you could see
Oh,
what that
right.
means.
Yeah. Yeah.
If it's 10% vacant, so we're looking at 5 empty weeks.
So
If
like
you're
about a month. Yeah. A little
yeah,
bit
a
more
little
than
over
a
a
month.
month. If you're
Yeah.
comfortable with that, then if you think that the market is very tight, that no, it's going to be just maybe 2 weeks or something, right? So you can kind of adjust it there. Okay. Um,
And just as a basis of comparison, like something, where I live in Orange County, it's a very low vacancy rate. So we might be looking at under 5%. I think the citywide vacancy rate for Costa Mesa, which I looked up when I first moved back to California, was about 3%.
yeah.
These are things that you could talk to a real estate agent and kind of get a sense for. If this property were in the smack dab in the middle of Seoul, in sort of like the best areas of Seoul, I'm sure the vacancy rate will be a little bit lower. And then as you get higher, 10%, maybe that's somewhere
Yeah.
not quite as popular. Just as a sort of general metrics.
Yeah.
I think most investors I know use between 5 and 10 as sort of like placeholder value.
Yeah. Yeah.
Yeah,
Unless data for the market tell you otherwise, right?
exactly. Yeah,
But you should. This is just a starting point, but you should definitely
yeah,
verify with market data.
right.
Because you don't want to be wrong assuming 8%, and when the market's more like 30%, then
Oh yeah,
you,
you might not want to invest then.
there's high vacancy, then you may, it still might work if you're getting it for a really, really good deal, right?
Right.
But then it makes you have to sharpen your pencils a little bit more.
Yeah.
So this is why we do analysis. This is why we have to take on these assumptions. So you, based on what you think is going to happen, is it still worth your time and risking your money to do that?
Yeah, and just right on line with that. I've heard this from much better, more experienced investors than myself. And part of why you do the analysis is because it forces you to think through these things, right? I mean,
Yeah.
you see a property, you get, you see the sticker price, you might get kind of caught up in, oh wow, this seems really cheap, and then until you do the analysis and you start to really put the numbers together, and it forces you to really think about who's going to be living here, how long they're going to be living here, and it makes you a better investor.
Yeah. So cool. Then the other thing is, hey, most markets, if there's growing demand for rental spaces, you can assume that the rents are going to go up over time as well. So that's why we have a rental growth rate here. If you don't know where to start, you just want to be able to initially make an analysis. Something around 3 to 4% is probably safe. But some markets may be 10%. Some markets might be 0.
Or negative.
Or negative. Yeah, you may assume like, hey, there's a lot of jobs leaving. There's gonna be less. Then in those markets, you might have to assume negative and see if it still works out. Then there's gonna be some costs for repair, depending on the older it is, and the higher your repair allowance that you're gonna need to make. The newer it is, you may be able to get away with less. So this is something that, as you make more investments, you understand, and you understand the type of unit that you're in.
Yep.
For something like an Officetel, especially if it's kind of recently renovated, you don't have a lot of other upkeep. It might be lower, actually.
Yeah,
So,
I think it probably would be. Yeah.
yeah.
And the interesting thing about Korea is that some of the repairs are actually the responsibility of a leasing tenant, even though even though it's not triple net or something. So that I remember I was living in an apartment, and I'd been living there for about 3 years, and I think my thermostat broke or something. I went down and I told the owner, and the owner was like, "Oh wow, this Korean guy's like, oh wow, that's too bad. You'll probably have to call someone to fix it." And I was just like looking at him like, "This isn't my thermostat. Why am I fixing it?" But that's kind of what the rules were. And I kind of, in the back of my mind, I had this revenge fantasy where it's like, all right, fine, but I'm taking it with me, even though I wouldn't need this like ridiculous thermostat piece of equipment in my new apartment. But so that's something that each market will be different, and also depending on the quality of your property, obviously.
Yeah.
All
right, and then the other thing is, wherever you're buying an asset, you're probably going to have to pay taxes, and you should get insurance
Yeah.
to protect yourself, right? So
Yeah.
I didn't put anything in here yet because I know
Yeah.
we're going to do a study here. So I don't know what the insurance rates or the property rates are in that
Mm-hmm.
area,
Yeah.
but we can make some assumption. I think insurance costs to insure a home range will be around what, like maybe like 0.5% a year. Is a safe bet,
Yeah. So
something
let's
like
put it
that.
in. Yeah. Let's see what.
You know,
Let me see. Yeah.
we'll just half a
Okay.
percent. This is about half. This is 0.5% of the
Yeah.
purchase
Right.
price.
Right.
And then property taxes, I don't know, is like 1%.
Oh, there's a very good article I believe that one of our organizers wrote on Korean property taxes, but
I
yeah, I don't
just
know
don't
offhand.
know what the
Mm-hmm.
property taxes are there. So that's why you got to know your market, because otherwise
Sure.
you might be using the wrong numbers. But we want to put something in here just so we're
Right.
not putting it in there. But
Yeah.
obviously this is a number that if you were to invest, you better verify that it's, you know, it's 2,500 and not
Right.
7,500. You know.
The insurance is also an interesting thing. There are a lot of Korean businesses that do not run with insurance, so that would also be something that you'd want to check with the if you're going to invest in Korea. I don't know if every investor actually purchases insurance the same way they do in America.
Okay.
Yeah.
Yep, something to figure out. And if you're investing remotely, you might need somebody to help you as a property manager.
Mm-hmm.
So usually if you don't have a lot of units, it's gonna be hard to get someone to manage it for less than 10% of the of your unit.
This is an interesting metric to property manager. For one thing, in Korea, a lot of the real estate agents will actually property manage for you for free because they
Oh
just want the
wow!
commissions. They want the commissions of placing tenants in the future. Because the real estate agent will help place a tenant, and then each time they place a tenant, they'll get a cut on that. And I know that one of our investors, he's got several. He and his wife have several properties, but they actually, I think, get away without having to pay a property manager, which is very nice for them.
Well,
And
wait, they're
the
paying a
other
cut of the rents?
there's a placement fee um
Oh, it's just a
every time a new
placement fee.
tenant every time a new
Okay,
tenant comes in. Yeah. And
okay,
that's actually 10% for a property manager. Every time there's turnover, most property managers will also you charge you a placement fee. So that all comes out to
yeah,
about
okay.
10%. And then one interesting thing though, in America, sometimes people are like, well, I'll just manage it myself, and they don't really do the 10%, which is, I guess it's okay if you plan on just holding this thing forever. But the thing is, if you think about your exit strategy and who you're selling to, you really limited yourself in terms of the sale. You to make the numbers work out the way it's been working out for you, the person who's purchasing the property from you would also have to want to property manage it yourself. So even if you didn't have a property manager expense, you might want to just add one in because you want to think about the exit. If you account for the property manager ahead of time, then the new investor who comes in, who's potentially buying this property from you,
Yeah,
will have that expense already accounted for, and that won't completely throw off your numbers or
yeah, that's a
something.
good point. Yeah,
Hmm.
you can make it pencil for you by kind of taking on a lot of the roles that as an owner, but maybe the next owner wouldn't want to do all that stuff.
Exactly, and that's the same thing with repairs. A lot of owners are really handy with the hammer. They like swinging that hammer and getting up
Yeah,
on the roof, and they don't necessarily charge themselves for that labor. And that ends up, when they try to sell it, someone else is like, well, you know what, that repair allowance is way too low because I'm not about to get up on the roof. So
yeah,
even though certain things may work for you personally, you may still want to account for them because you want to think about this as an investment that later on you're going to sell to someone else.
yeah, and cool. Yeah, and then I think the tenant takes care of all the utilities, right?
Yes, that
Okay,
would
so I'm
probably
gonna
be,
put a
yeah,
zero there for the
yeah,
utilities. But in some places around the U.S., the landlords will cover utilities to a certain amount. So
right, right.
it's here for comparison. So so that kind of that's the bulk of the work here.
Hmm.
If you're just investing by yourself, then once you put all that in, you get to see the results here. So right here, what we're looking at is, there's one more thing. We put an assumption of 7.5% for a discount rate for net present value. Now, if you don't know what net present value is, we'll talk about that later.
Hmm.
It's just a little bit beyond the scope of the
Yeah, it's gonna
discussion
take a while to.
today. Yeah, it'll take a little
Yeah,
while today.
yeah.
But just think about it as your kind of your best alternative for investing.
Mm-hmm.
And if and you're comparing a current investment opportunity against it, then if it's not better than your best alternative,
Mm-hmm.
then it's not looking very good. So in this case, if you're doing it all cash, you're looking at really about a 5% return
Mm-hmm.
on your investment. And because the discount rate was set at 7.5, it doesn't look good. It becomes a negative investment, right?
Right, right.
Um,
So
so
basically, just real quickly on net present value, because I know time value of money might be things that are new to some of the listeners out there. Um, that 7.5% is what other opportunity you could put your money into and get a 7.5% return.
yeah,
So it's like what Simon said earlier. It's like, what is your alternative for investing? Because as an investor, you're not just looking at how well this investment is, but you want to compare it to versus what other types of ways you could put your money and get returns. So in this sort of hypothetical situation, Simon's using 7.5% as a discount rate, basically saying I would also have an opportunity to invest my money at a 7.5% annual return. So let's compare it to that.
yeah.
Okay, great.
Yes, and because we did it all cash, we see that the leverage return and the unleveraged returns look identical, right?
Yes, yes.
But then let's take a look. What if we put some debt around this? What if we
Okay,
only do 25% down, right?
okay.
I don't know
Yeah.
if what the banks there with the limits in terms of minimum or maximum.
Let's try 30. Let's just see what
30.
30 looks
All
like.
right,
Yeah.
30%. So then that means you're investing that much and you're borrowing the rest at 25%, and at 25 years at 5% interest.
Mm-hmm.
And now we see that the leverage return looks very different from the unleveraged return.
Mm-hmm.
Now, because the leverage is cheaper than the return of the investment, the dollar for dollar investment now is better. You're
Right.
getting almost a 10% return for every dollar you put into the investment. You're putting in less now, only 30%. You're getting $1.66 back. Whereas if you
Mm-hmm.
did it all cash, you would only get $1.28 back. Now
Right.
this, yeah. So it won't always be the case. This is a case where you have positive leverage. You can get
Mm-hmm.
negative leverage if if the debt is more expensive and really expensive, and it actually eats up all your returns.
Right.
Then in that case you're gonna actually do as well.
Right. 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 And that's
So
also yeah, it's something you'd want to look at. Another variable you might want to look at is your debt coverage service ratio, which basically says how much room you have after you pay your monthly mortgage to the bank. And that's something that the bank will be also very interested to know. They want to make sure that, let's say the debt is $1,000 and you're making $1,001.
yeah,
Well, they're not going to loan you that, even though you're covering your debt, because it's like $1 is not a lot of a cushion there for the bank. So
yeah,
yeah, yeah. So that's also another thing that you might want to take a look at once you start to apply the leverage.
So cool. So then once you have that, let's say you I'll put it back to 30%.
Hmm.
And then what you have is when you look at the deal summary, it kind of gives you that project. Here's what your cash flow look like if you're doing all cash versus if you have some debt.
Hmm.
If you take on debt, you're obviously putting less money up front.
Hmm.
But as you can see here, here's the important thing to think about. Already in this case, where most of pretty much all the returns coming from appreciation.
Oh, wow. Yeah, you're
Yeah,
going
you see that
negative.
you're
Yeah.
actually out of pocket for the 4 years
Okay.
during your hold. It's actually
Right.
covering. Yeah.
Right. Right. Yeah. Yeah. The parentheses, for those of you who are unfamiliar in financial terminology, that means a negative number. So that means each year you're losing money. That means you're paying the bank
Yeah.
the debt, but you're not actually making money. So not only does this debt not look great if you're looking for cash flow, but the bank is probably unlikely to loan it to you because you can't cover it.
Yeah, exactly. Yeah.
Hmm.
So that's why you run the analysis, because even though it looks good here, it's because the overall returns actually look okay, from on
Hmm.
a leverage basis, but it's all because we put a
It's all because of
5%
the appreciation. Yeah.
appreciation. Yeah. I mean, if
Yeah.
we kind of if we take that away, then it's going to be pretty bad.
Yeah.
Let's look at the project.
Uh,
Right, so you can be
yeah.
negative here. All cash, you make a little bit, but then here, like it's really negative now.
Yeah. Yeah. Yeah.
So,
Yeah.
but
It's like yeah.
that's usually not going to be the case. So look here, you're going to get worse return actually
Right.
than
Terrible.
yeah. So the debt actually doesn't help because you're already not making money
Mm-hmm.
when it's just all cash. But then if you take on debt, then you're going to be doing even worse.
Right.
Yeah.
Yeah, that is not the kind of investment you'd like to make.
Yeah.
Although I guess in some places like California, you might be looking at negative cash flow, and people are just banking on a huge exit at the end,
Yeah.
or they're trying to get the tax write-off through the income being lost.
Yeah. I mean, it's for a very different reason. Like, they just want to stay in California. They think maybe a
Yeah,
market for a good kind of a haven to protect their assets.
right. Protect their cash. Yep.
Yeah. 'Cause
Yep. Yep.
you're not likely to see some sort of a major, you're not going to see the kind of downturn that, you see in like Detroit or something for like
Right. Right.
LA. Yeah.
Sure. And
Um,
if you have a house up in San Francisco and something like that could actually make sense. If you as long as you can hold out and you have enough to cover your debt each year, then it could potentially work out really well for you.
yeah.
Although I think most of the people in our group are not probably in that
Yeah.
position. They're probably thinking more about actually using cash flow to leave their day job or something. So
Yeah. So, one of the things here then it's for this particular investment, it's really relying on this appreciation. You can't just, it's not just a nice to have, it's a must have if you're going to invest in
hmm
this one. Um, and that's because the rent that you collect for the purchase price is actually relatively low. Most of the
yeah.
time, for something that where your returns are pretty healthy, you want to try to find something where the rent is closer to 1% at least of your purchase
Yeah.
price. This
hmm
is less than 0.5%.
hmm
And that's really what makes that kind of difficult. So, what would happen if it was closer to like let's double it, right?
Okay.
Let's make it
Yeah.
like 200, 2,000. I mean,
Yeah.
so it's closer to like zero point 0.8, right? And then your returns look a lot better, right?
Right.
On your leverage and unleveraged basis, you're still positive, although
hmm
less obviously here because you're paying for the debt
hmm
still. But that plus the appreciation, then your returns will look way better.
Right.
Um, so
Yeah, that's one thing. When I mentioned earlier, I invested in Jacksonville with Ben, one of the other organizers, and we were actually looking to get a 2% ratio of rent to purchase price. And when the closer the higher the ratio of rent to purchase price, the probably the worse the neighborhood. So you have to be very careful.
yeah,
Like someone in Detroit might try to sell you a property. It's like, hey, we're getting 4% rent to purchase price ratio, but you might be in an area that's
yeah.
really
So yeah,
difficult to
I'd say like
invest
you
in.
don't want to look at just what the face value rent is. You want to look
hmm
at aggregated collected rent.
hmm
So for most of those neighborhoods, if you just look at any given month, it might be like 2%. But you say no,
hmm
I want to look at it over the last 2 years and
Yeah.
collect it all together. What was actually collected,
Yes.
audited? It's going to be
Yeah.
actually less than 1%, right? Because you're not going to
Exactly
be
right.
able to
Because they're gonna
collect. Yeah. So what we're talking
economic
about here
loss, as
is
they call it.
net collected
Yeah.
collectible rents. Okay.
Yeah. hmm
Um, and that can make a big difference. Yeah.
hmm So as you get more familiar with these metrics and numbers as an investor, I mean, you will start to look at these numbers and you'll start to see something, and you'll say, "Oh, that's 0.4% monthly gross rent to purchase price. That's probably a really nice neighborhood." I mean, it
Yep.
may or may not be, but you'll know right away what sort of property you're dealing with.
Yep.
So that's also something like getting more familiar with these numbers will actually help you to get a sense of what each of the areas that you're investing in are like
Yeah.
before you do the due diligence in that particular area.
Yeah, and that's why a lot of at least when I'm talking to a lot of my students that are doing more rental type investments, they tend to try to look for markets that are in the path of growth. They're not
hmm
in the prime like real like A grade like downtown real estate where you're not gonna get that right. But
Yeah.
maybe they're kind of in a neighboring city where the sprawl or the growth is headed towards, and then there's more and more movement there. There's more and more
Yeah.
businesses and development. That's where
Yeah.
if you get in kind of early in those markets, you can get it at these rates, and then you're gonna experience more of the growth and appreciation.
Right. And if you're in the Seoul Real Estate Investing Meetup group, just make a note of this. You might want to write this down. We have had speakers come on and talk about Path of Progress. We've had people, speaker who works for something called Kojex. It's like a project he put together. And what he does, he just studies transportation patterns because, if there's a subway coming into a neighborhood, that's going to dramatically change
Yep.
traffic patterns. It's going to, potentially increase the value of properties and things like that. So just make a note if you do have questions about that, you're kind of curious to know some of the information that the speakers provided at some of our other past talks, just go ahead and send a message or leave a message in the Facebook group, and I'm sure someone will respond to that.
Cool. Well, I think that's it for this analysis.
Yeah, this is great. I hope everyone sort of got a lot out of it. I know we went through it very quickly. We didn't necessarily go through every single data point and explain what's going on. But if you have any questions, definitely feel free to post them in the Facebook group or wherever you see this content being placed. Just leave a comment or something. Symon and I will jump in and try to answer your questions as best as we can. And just want to add one more encouraging note. I know some of this stuff, if you haven't seen it before, may seem Greek or foreign to you. But I got to tell you, when I first started looking at spreadsheets, I had no idea what I was looking at. I had no idea what any of these numbers meant. And it just takes a little while. It takes a little time, and you can just continue to learn. It's like learning a new language. You don't learn a new language overnight. But over time, you start to understand these things, and you see words like leverage, and you're like, oh, okay, that just means there's a loan on it. And once you know it, the great thing about real estate investing is like once you know what it means, I mean, it's with you forever, and you can always apply that knowledge to any type of real estate investment that you see in the future. Symon, anything you want to add about like the complexity and maybe someone who's sort of looking at this for the first time and being a little overwhelmed by it?
In the beginning, yeah, you definitely just want to take your time. Is like putting training wheels on at first. You're gonna need it initially. Just talking to folks like us or reading and getting some extra materials. Let it kind of digest a little bit. But it's like learning a bike. Once you learn it, you'll never lose it, and
Exactly.
and it just becomes second nature to you. You'd be like, wow, why was I struggling with it at first? And you know what? Everybody struggles with it at first.
And I think, relatively speaking, real estate finance is, I mean, you look at other types of finance like stocks and bonds and all this other stuff. I think real estate is probably a little bit simpler in a sense. But the great thing is once you understand the finance and the metrics in real estate, you'll learn that other assets, bonds, stocks, other kinds of investment assets, they all sort of use the same language. So it kind of, it helps you. It opens up an entire world of investment potential and possibility and being able to understand all that stuff as well.
Yep, absolutely.
Okay, well, we want to thank you, Symon, for taking time out of your busy day to come up here and help us analyze this Korean Officetel case study. Also want to let everyone know that Symon and I are putting together a course on financial analysis. We'll be releasing the details soon. So if you're interested in understanding the stuff a little bit better and getting some more information about this, there will be something coming up soon, and I'll keep everyone posted on that. Anything you want to add, Symon?
No, that's it. Thank you, everyone.